The global trade war and domestic economic uncertainty has investors looking to diversify their portfolios in both the brand new and tried and true ways. Joining me now are VanEck and Associates CEO Jan VanEck, as well as Sprott Asset Management CEO John Champalia. Thank you both for being here with us on ETF Edge. And Jan, maybe I just want to start with you first. This week, you launched a fund targeting alternative asset managers. And viewers, we should reiterate that this is brand new. It's a fund that has just launched. I guess maybe what we want to talk about first is why alternative asset managers, and how do you find the demand profile right now among investors and investment advisors for a fund that tracks alternative asset managers?
Sure. Well, John, what's happened in the world is that a lot of the financial markets now are not public. They're not visible. The stocks that are private, that are venture-backed, are not trading on the stock market, and they're not going IPO. So there are about 1,200 what's called unicorns, beating private venture-backed companies worth over $1 billion. So these are companies, they're going to make it. They're profitable, but they're staying private for a super long period of time. SpaceX is probably one of the most famous ones of those. So the people that manage those private equity funds or private growth funds, those money managers are public themselves. So this is a play on that. The other part is the private credit market. So since the financial crisis, the regulators told banks to stop risky lending, right? We want the banks to stop blowing up every 10 years. So a lot of lending to corporate America actually happens privately, offering really attractive yields, 10 or 12%. And that's grown a lot. We actually offer a version of that in our BDC ETF called BizD, and that yields 8.8% today. So anyway, that alternative credit world, so private lending is another part. So it's private stocks, effectively, and private loans or bonds. And the managers of those, everyone's kind of wanting to get into it. People expect allocations to private assets to grow from about 2% of wealth to 10% of wealth. And if that happens, these managers will do really well. And the ETF is GP because the managers are called general partners.
All right. So one of the other things that we want to take a look at is the reason why you are turning towards the managers themselves, when even today there are a slate of certain types of products, exchange traded and whatnot, that actually track some of the private markets themselves. I can think of ETFs, or one ETF in particular right now that has a huge tilt towards the private credit side of things. And we can talk about some of the other asset managers out there who have private equity investments themselves. What exactly is the use case, and how exactly should investors and the maybe investment advisors out there who are thinking about possibly allocating towards this type of space, what types of things should they think about as they look towards investment on an ETF side for the asset managers themselves as a portfolio?
Yeah, that's a great question. I mean, I think you have to believe that this is a secular trend and that these companies will grow at a higher rate than normal money managers, right? So you have normal money managers called mutual fund managers. Mutual fund assets have not grown very much. Then there's ETF managers like ourselves, but there are very few ETF companies, maybe Wisdom Tree, that are public pure plays. But there are enough private asset managers, and these private asset managers have grown from being boutiques to being really large, professional services firms managing almost $500 billion each, the Apollos, the Ares, and they're involved in both the private credit and the private equity side. So they're just super impressive firms. And if you believe that they'll continue to grow and be part of the ecosystem, then you want to have access to that. I will grant you they are a little bit more volatile than the overall market, right? So it's a little of a high beta play on stocks overall is kind of how I think about it. So you have to size it appropriately.
All right, and Jan, one kind of tie up at the end here. When we talk about the liquidity aspect for some of these names, they're not necessarily the most liquid out there in terms of the asset managers that trade out there. I can think of some of the big private equity names that may be different.
Yeah.
But when you take a look at your portfolio, how exactly should investors view the risk profile when it comes to things like how this ETF functions with regard to premium and discount to NAV, given some of the types of names and products that you're talking about right now?
I mean, these are larger cap companies. I mean, somewhere between 10 and several hundred billion. So I don't think liquidity is going to be an issue with this ETF.